Good morning.
Hi, we're still getting ready.
The firefighter pension board meeting to order at 10:03. Present.
Present. Present.
Kennedy, Justin Campbell. Okay, I have them as absent.
I'm present. I'm here.
Oh, Justin, you're there?
Yes, I'm here.
Thank you. Next item on the agenda is the swearing in of Art Leary by the city clerk.
At the microphone, please. If you would, raise your right hand and place your other hand on the Bible. I, Arthur Leary,
I, Arthur Leary,
do solemnly swear or affirm
do solemnly swear or affirm
that I will support, protect, and defend
I will support, protect, and defend
the Constitution and government of the United States
the Constitution and government of the United States
and of the state of Florida
and of the state of Florida
and of the charter and ordinances of the city of Palatka,
and of the charter and ordinances of the city of Palatka,
and that I am duly qualified to hold office
that I am duly qualified to hold office
under the requirements of the Constitution of the state,
under the requirements of the Constitution of the state,
and that I will well and faithfully
and that I will well and faithfully
perform the duties of Firefighters Pension Board member
perform the duties of firefighters pension board member
on which I'm about to enter.
on which I'm about to enter.
So help me God.
So help me God.
Thank you for your continued service, Mr. Leary.
Next item on the agenda is the approval of minutes. Everybody have a chance to review the minutes from the previous meeting?
Motion to approve the minutes.
Motion made by Dowell,
Second.
second by Mr. Leary. All in favor?
Aye.
Aye. Motion passed. Next up is the review for the suggestion for the experience study from Foster and Foster.
Yeah, can you guys
Discussion.
see and hear me?
Yes, sir.
Basically, every 5 years, boards are supposed to do an experience study where they look at all the experience in the plan and then tweak the assumptions going forward based on that experience. So we do a study and we show you all your experience, and then we make recommended changes, and then we show you what those recommended changes would do to the city's funding requirements. And we talked about it at the last meeting, I think, but you guys wanted a quarter to ponder it. And I think you guys were going to make a decision at this meeting.
What year was the last time we did it?
It was in September of 16. So it was exactly 5 years ago in September. If you guys
Okay.
did one for your September meeting, it would be exactly 5 years.
I don't know where to go with that, Miss Jill. I know that the city's trying to figure out some having meetings for salary studies and everything else. I don't know if we should wait and see what comes from all that if we spend this money to have this experience study done, and then say October 1st, the city comes up with whatever they come out of all this stuff they're meeting on. I'm not part of that, so I don't know much about it. Are we getting data that's not going to help us in what we're looking for? Should we?
Well,
Like if you're talking about salary increases in particular, we don't necessarily look too strongly at a current contract because it's for a 3-year period usually. And, we're looking for the next 30 years, what we expect salary increases to be.
well,
So
that's exactly the issue that he's trying to explain, is that the city is going through a outside company to do a salary study because of the $15 minimum wage that's going to be imposed on the city in the next 5 years. So they're doing a salary study to get all employees up to that $15 minimum. So by doing a salary study now, or your experience study now before the salary study comes out with its information, does that affect your experience study? Or
'Cause it's
are
not-
you only looking in the past?
Because it's not just the fire department, it's gonna be citywide, so it's gonna affect all your other boards too. It's not
Exactly.
just this board.
Well, like I said, it's good information to have if they're going to, give everybody automatic 10% increases for the next 5 years or something. That would be helpful when we're determining our determining how to change our salary increase assumption. But like I said, we mostly look at past experience and we look at, what other plans are doing. And we do take into account a salary survey like that you're doing. But you'll probably, like it sounds like you would bump everybody up, immediately. And then after that, you'd be back on your regular salary scale. Every year going forward, you would give 3% or whatever the normal salary structure is. So
But
when we're talking about this assumption, it's really that long-term, what we expect each year salary increases to be.
this is basically looking for what the city's expenses are going to be predicting forward, correct?
Yes.
They're funding their pension plan expenses.
Yeah,
Right?
they're funding for the pension plan. So if they do some sort of drastic increase in pay raises, that's obviously going to have sort of drastic increase in the city's expenses to fund the pension. So I feel that this should wait until the city maybe table this till September meeting and see if anything's come from that when we're closer to budget, see what happens.
Yeah, I mean, that's fine. I mean, you can always just do it next summer. I mean, 6 years isn't that much different than 5 years.
Does it have to be done in the summertime?
If you think you're gonna have a lot better experience. Well, no, we could do it anytime. Yeah, if you want to just wait and see what happens and talk about it again in September, that's fine.
I do know that the RFP is supposed to be going out and all the information is supposed to be coming back so it can get in the budget in July.
Okay,
So it's not like we're gonna wait forever. We're gonna know a lot of information by September.
I just feel, I mean, that if we're trying to figure out what the expenses are going to be for the city's plan, that we should try to give them some accurate numbers to give us back accurate numbers.
right,
And I don't
right.
know what's going to happen with any of that before, I mean, like I said, I'm not involved in any of that, so.
Right. I'm not.
Yeah,
either.
that would be
I know,
fine.
so. Questions?
No questions. I say
I'd
we, I
wait.
say we move it back to September and re-adjourn at that time.
All right. Do we need to make a motion on that or just table it till September?
As far as you don't have to have a
Okay,
motion.
we'll reassess it in the September meeting. Any other questions on that?
No, sir.
All right. Next up on the agenda, Sawgrass report.
Good morning.
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 It's good to be back in person on meetings. This is my second one. The record, my name is Greg Gosh, I'm Client Services Manager. We are your fixed income manager. Welcome to the board. You may have been on board for a while. But we haven't been in person for a while, so my apologies. But I'm going to just give you a couple of quick rundowns with the firm. And Leardon Gila is your portfolio manager. He is going to talk about the bond world, where it sits today, some economic news, how we're positioned, and how we think things are going to move forward. Because right now, we have a lot of things going on right now, a lot of things that don't make a lot of sense. We have inflationary pressures with the supply demand issue that's going on right now. We have very low interest rates and rates that rose significantly in the last year. Oh, they'll be all right. And yeah, you have a Zoom button and a microphone button. I have to figure my voice was loud enough. But we have inflationary pressures going on right now that anybody with a newspaper or television understands, or that shops understands. And interest rates rose about 100 basis points in a year, up to 1.7 on the 10-year Treasury not long ago. And in the last 4 to 6 weeks, they're back down below 1.5, and now they're kind of bouncing back up to 1.5. But when you see the reality of the economy starting to reignite itself, people are traveling again, restaurants reopening, et cetera, you would think maybe, in the Fed's meeting right now, the FOMC next 2 days are meeting. You would think that maybe they're either waiting to see some more evidence of this fiery economy to increase rates. Or it could be that we're not there yet. And there's a lot of other things going on right now, like incredible amounts of debt. We look at all the different QEs from the financial crisis. We look at during the Bush administration, stimulus spending, and those different, and even in the Trump administration, they were child's play compared to what we're seeing now in terms of government debt, government payments, and taking on trillions and trillions of debt. That's going to be something that's going to affect how we're moving forward. But on the other side of that, again, we're starting to see the economy open up. So the experts like Learden are the ones that have to do that balancing act. Where do we want to be conservative? We want to be, we're that bedrock. So when the stock market has volatility, we're keeping things less volatile for your overall plan for your pensioners. But the stock market and the bond market can be volatile right now. And we saw that in the first quarter with the bond market. Learden's going to talk about that. So with that, as I'm kind of going around and around in circles here, and Learden can kind of bottle everything up and make things more concise, I'm going to let Learden go through everything here for you. But any questions about the firm or anything else?
No, sir.
Good, sir.
All right.
Glad to see you again.
Good to see you. We appreciate your business. We're right up the road. Anytime you guys want to come up for an office visit, or we're right there in Jacksonville Beach, just about an hour away. And we appreciate your business and your confidence. Thank you.
Thank you
I
for
have
coming
a
out.
question for you.
Yes.
And it involves that I was doing the bank reconciliations for the fire and police, and Sawgrass gave the pension back for this pension $10,500.
Learden's going to address that for you. Okay.
Thank you.
What she's asking about is when we moved over to the CIT, which we talked about last December. So we're talking 7 months ago, 8 months ago. One of the questions was, hey, it's the bond market. If, being out of the market a day or two, it's not going to be that big of a deal. When we're moving from the separate account to the CIT, which is the exact same. It's the same fund, but it's easier to get in and out of. It's more liquid. It's like a mutual fund. So what happened was the volatility that was going on in the first quarter made that untrue. So we thought it would be in our best interest and the firm and our client's best interest to say, hey, we're gonna take care of this volatility that we did not foresee. And Learden's gonna explain that to you. Only with 6 minutes. Hey, you're lucky I didn't.
Thank you, Greg. Good morning, everyone.
Good morning.
Morning.
My name is Learden Gila. I'm a fixed income portfolio manager at Sawgrass. First of all, I'd like to thank you for the business. We appreciate the opportunity to manage your fixed income portfolio. It's a great honor for us. As Greg mentioned, before I begin with the presentation, I'd like to give you a quick update on the CIT, the fund managed by Sawgrass. You made the decision to convert your separately managed fixed income portfolio into that fund. And the primary benefit for that was basically the same strategy, but with a much lower fee. So you're reducing the fee, and the goal was to have a much better net of fee return over the next few years, which will benefit your overall plan. So in that process, that transition process required us to have the portfolio sit on cash for 1 full day. Unfortunately, it wasn't, in our jurisdiction per se. It was really the custodian of the fund that required that process to happen. And we just so timed that 1 day that your portfolio was out of the market to have a very volatile day, and the market rallied on that day. And we had a conversation with Burgess, and we came to the conclusion that we wanted to make you whole for that 1 day that you didn't participate on the up rally. And that basically, we did the math, and that ended up being a $10,400 difference. So Sawgrass cut the check for you. We send you that check for that 1 day return. So for the full month return, your return matches the strategy return for all the other clients that we manage.
All right.
We wanted to make you whole. We appreciate your relationship. We value your relationship, and we wanted to make you whole. We wanted you to be indifferent from a return standpoint. On the other side, on the flip side, if you were to say be in cash and the market would have sold off, you would have still benefited because you wouldn't have taken the negative return. But we wanted you to participate on both sides. So that's it. So in terms of the process, that overall transition process is complete. You're fully invested now into the CIT fund. The strategy, as I mentioned, is the exact same strategy. The only difference is the slightly lower fee that you will benefit. Today, we're talking about the first quarter, so we're still talking about that separately managed portfolio. Going forward, starting next quarter, meaning the second quarter, you will see a new statement which will show the fund in your statement and your unit holding into the account. But keep in mind, the overall strategy is still the exact same strategy that Sawgrass has been managing for you over the years. Any questions with regards to the CIT, the fee, and the transition related questions?
No, sir. So the old fund that you're referencing is the HCQFI?
Correct.
Okay.
Okay.
And what is the fee now on the CIT?
So the total fee, which includes the custodian part and the management fee that is not related to the Sawgrass Asset Management, that's 29 basis points total wrap fee.
Okay. Thank you, sir.
Yes. So moving on with regards to the quarterly review. If you turn with me on page 12, I just wanted to give you a quick accounting update here. We started the calendar year with a portfolio value of just a little over 2 million. We had a big cash inflow throughout the year of 463,000. Investment net gain loss of negative $5,800, and that brings the total market value as of 3/31 of this year at 2.5 million plus. In terms of the performance, if you turn with me on the next page, on page 13, as Greg mentioned, the first quarter was a very volatile quarter for the bond market. Actually, it was the worst start of the year. One single quarter return since the 1980s. We haven't had that type of volatility in the bond market in a long time. We did underperform on a negative quarter, and I'll talk about the attribution in a little bit. But even with that negative number, we're still looking at, if you look at a 3-year and 5-year basis, we're still looking at some solid numbers from the bond market. And we're still ahead of the benchmark on those 3-year and 5-year basis. And also, if you just go back way back since inception days, we're still ahead of the benchmark. And you still have realized some decent positive numbers of 4.6% since inception. But more recently, 3-year 5%, 5-year 3.4%. These are fairly decent numbers coming from a very high quality core mandate in the fixed income market. In terms of the drivers of the spike in rates that we saw in the first quarter, you got to put things in perspective. You just realized in your portfolio 2 really good years. Last year, you realized an over 9% absolute return. Given the volatility of that crazy year, you should be really happy with that type of return. And the previous year, 2019, that was another really big, huge year. So we were expecting a little bit of bounce back from the rates. And we did position the portfolio with a more conservative approach, meaning shorter duration than the index. But we didn't manage to outperform the index because we had an overweight in the mortgages, in mortgage-backed securities. The reason why we went overweight mortgage-backed securities at the time, back late 2020, the economy was still very, very severe in terms of the overall status. The Fed had communicated to the market that they intend to keep the rates for a long, long time. They were talking 2024, 2025 in terms of rate hikes. So we were envisioning that, yes, we'll get some rate increases, but we will see this kind of a muted volatility, rates hovering around those same levels. And we thought that having a carry strategy in your portfolio made sense at the time. And that's why we went overweight mortgages, because on the credit side, spreads were really, really rich. And we thought relative to mortgages at least gives you that carry without the credit risk. Well, on the mortgages tend to not perform well when you have huge spikes in volatility, when you have a rapid increase in rates. And we got that scenario that we didn't forecast, a huge rapid increase in rates. And that causes mortgages to extend maturities because your you think about it, your refinancing option goes out of the money, and therefore the maturity of that security increases. Well, it increases at the wrong time, right? As rates are going up, your maturity increases. So that was the primary driver of our negative excess return for the quarter.
Okay.
Another interesting fact I wanted to point with you on page 14. This is the change, the quarterly change of the overall treasury curve. This was another interesting fact. We were positioned conservative, meaning shorter duration. But when you look at how the curve behaved, how the maturities behaved, we didn't get that uniform increase in rates, meaning the intermediate part of the curve, that 5 to 10 year, part of the maturities underperformed the most. It's interesting, the 30-year bond actually outperformed the 10-year bond. Well, when you have this inflation scare, typically, and the Fed is not doing anything, empirically, you get a huge, what we call the steepening, meaning the longer term rates vastly underperform the 10-year rates because the Fed is letting the inflation loose. And we got the opposite on the quarter, and that hurt us a little bit from an attribution standpoint. But so the overall drivers of this big rate increase, as Greg mentioned, the economy is basically gradually opening up. At the time, late October, late November of last year, we got some really positive news in the vaccine front, and that really sparked, the speculation of the economy opening much faster than everybody was anticipating. In addition to that, the labor market was improving, and it continues to improve. And most importantly, the inflation fears are basically the current theme dominating the bond market. What is the Fed doing about it? The Fed so far has given us the message that, yes, we're seeing these spikes in inflation, and they tend to be in certain pockets, primarily on the industries that were really hurt last year, such as travel and leisure. You've got that huge pent-up demand that is going to really support that pocket of industry. But keep in mind, that's only 6% of the overall economy. Everybody talks about, oh, look at the airfares doubling and hotel rates doubling. Well, that's only 6% of the economy. The 94% that was booming last year because people were at home buying durable goods, buying all kinds of projects, improving their homes. Well, those are big ticket items. That would be what we believe will be the counterbalancing factor to this this big inflation theme. So therefore, we believe, just like the Fed believes, that the inflation would be more of a transitory phenomenon. We're seeing these big spikes in commodities. But again, these are all transitory phenomena. Take an example of lumber, for example. Well, lumber is affecting the housing market. The primary reason why lumber spiked so high is because of the capacity was off. The labor was not supporting the overall demand for the housing. The cure for high commodity prices is high commodity prices, right? You get the profit signal, and then all of a sudden you get the supply following because everybody's trying to capitalize on that high price. So what we've seen in the last 3 weeks or so, lumber prices have actually collapsed by 40% from the recent high. That's because the capacity is coming back on slowly and trying to meet that demand. Just like lumber, we expect a similar trend on most of the commodities. They tend to be very cyclical, and we believe that as the economy recovers, the supply will match the demand, and you'll get back to that normal long-term run rate of 2 to 2.5% real economy. And that's our forecast. Therefore, we believe the rates will increase a little bit, but we're not going to have this runaway inflation, these runaway rates that we've seen in the 70s, and that's the biggest fear. I don't think we'll get to that type of level. So therefore, we're still maintaining a defensive position, but we don't expect significantly higher rates from these levels. So just with that quick summary to kind of follow up on our current positioning, if you turn with me on page, let's just see here. On page 26, this looks at the changes that we made in your portfolio for the quarter. And I talked about the mortgages, the fact that they underperformed. We didn't sit still. We took action. We reduced the position. So we went from an overweight position in mortgages. If you look at that bottom half of the chart, it talks about the allocation quarter over quarter. And you can notice that that big change in the mortgage sector. And most of the proceeds from the mortgage sales went back to the Treasury. The way we thought about that swap, that change, is as rates increase, it makes Treasuries a lot more attractive from a carry standpoint. And especially relative to mortgages, it's a lot more attractive now versus what it used to be last year. So, and you get a much more certainty from an interest rate standpoint. So you get a similar carry, but better certainty from an interest rate risk standpoint. We like that better mix. So we move from mortgages back to treasuries. And if you look at the next page on page 27, this is the current position of your portfolio as of the quarter end. You'll notice a big overweight in the treasury component. And that is a little bit new. If you look at the historical allocation of Sawgrass, we've tended to be underweight, and pretty much most of the bond managers, they tend to be underweight treasury, and they tend to ride that spread beta, if you will. But we believe that in this kind of environment where Fed is essentially supporting every financial asset, stocks, real estate, any financial asset, you name it, it's all being supported by the Fed put. And even bonds. Everything is expensive, but it's not just bonds. Everything is expensive. So everything is being supported by the Fed put, to the point that we've reached the level of current credit spreads at record levels. And if you adjust it for two main factors, such as the quality and maturity. So a lot of these CFOs of these companies, they are more comfortable with a much more levered balance sheet. So they're more comfortable with with a downgraded rating of their balance sheet. But not only that, they've termed out their maturities. So they moved from a 5-year maturity debt to 30-year maturity because they're taking advantage of these low rates. But from an investor standpoint, now you're left with a lower quality credit, a longer maturity, which means it's a lot more sensitive if things go wrong, and record tight spreads. We don't like that mix. It's, risk reward. It's highly skewed to the downside. And all it takes is, just some update from the Fed that we're not supporting the market, or we're starting to taper, or we're thinking about tapering, not even tapering, but thinking about tapering. And we would see a bit of a correction on the risk markets. So that was one of the primary reasons why we're still overweight treasuries. We're slightly underweight corporate bonds and slightly underweight mortgages. We have a lot of dry powder, and when the time is right, we'll get back to the risk markets. So that is our initial view. As I mentioned to you, expect slightly increase in rates, not a big runaway, inflation runaway rates that a lot of these pundits are talking about. We don't expect that type of environment. Everything is rich. We're just, we've really significantly increased the quality of your fixed income portfolio to have that dry powder and take advantage when the time is right, when spreads widen, when risk sells off, and that we will be there with a lot of dry powder. So that's what we're planning. But as I mentioned, spreads are very, very rich. We're not really giving up much, by moving up in treasuries. And one way to prove that to you is on page 31. This is what we call the simulation analysis. It basically gives you some expected, forecast for the total return for your portfolio. And we put together several scenarios that shock the interest rates, they shock the spreads, to kind of get a gauge of not only the forecasted total return, but also how would your portfolio do relative to the benchmark. So if you look at the scenario number 3, under a no change scenario, so if nothing happens with rates or credit spreads, we would actually still outperform the benchmark by 31 basis points. And that's the benefit of what we call what I talked to you about, treasuries owning the right maturity that has the maximum carry strategy. That is when it comes into play, where it gives you that excess return. And then finally, when you look at the consensus forecast, where you take the median forecast of the top world economists, that's number 12, even under that scenario, we would still expect to outperform by at least 50 basis points. And you would expect to generate a low single-digit positive number, which, in this day and age is still respectable, given the quality, the benefit you get from the fixed income, from a high-quality fixed income portfolio. Burgess will talk in a little bit about the benefit of the diversification, making sure that your bond portfolio is high quality. You want bonds to be bonds in times of distress. One proof of that, and I guess I'll end this with this page, is on page 33. This is a little bit dated. This is as of June of last year, but it's so important to remember what happened last year. And that's what we keep stressing to our clients. You want high quality strategy in the bond portfolio. Q1, we all know what happened in Q1. Everything just fell apart. Credit market froze, equity markets crashed. There was just no liquidity. Well, Sawgrass was one of those few managers that not only we outperformed the benchmark, but we were one of the few managers to provide liquidity. And if you wanted liquidity to rebalance your portfolio, meaning move some more allocations from bonds to equities at the right time, you would have been able to do that with Sawgrass. Not many other managers would have allowed you to do that, to make that opportunity. But we're not just a one-trick pony, one-dimensional. We're basically a very relative value-oriented shop with a high-quality touch, right? So if you look at the second quarter, we still managed to outperform. And the second quarter, by the way, was the opposite of the first quarter, was the risk on. That's when the Fed came into the markets and they said, we're going to support everything. And everything was basically risk on. Well, we didn't sit tight. We took advantage and we piled on risk because we thought that we would get compensated for that risk. So this is a true illustration of what I mean by high quality, relative value focus. It will definitely serve your portfolio, bring that, provide that diversification when you need it the most, and at the same time provide some decent relative returns. With that, I'll conclude my presentation and I'll take any questions if you have any.
Yeah.
I oftentimes want to bring up things that managers don't talk about because maybe they don't think you're interested, but I'd like you to put some color on the challenges that you face with the Fed, because the Fed is a major force in this endeavor and trying to figure out which way the yield curve is going to go and where there's going to be value and so forth. Given the inflation expectations, we saw the PPI numbers came in this morning pretty high. Normally you would see bonds falling apart with this type of news. What's going on this time?
Well, they're looking past that one big number. And as I mentioned, the transitory phenomenon is real. And the Fed is supporting the market to the tune of $120 billion per month. So every month they come in and buy $80 billion worth of treasuries, $40 billion worth of mortgages. That is what we call the quantitative easing. What that does is provide more liquidity in the financial system. It liquefies the system. It keeps the rates down because they're buying the paper from the banks. The banks get the cash and they get to reinvest that cash in other areas. So essentially it provides liquidity for banks, it liquefies the financial system, but more importantly, to your point, it keeps the rates down. When you keep the rate down, you put a bid on risk assets, right? That's why stocks are trading at 35 PE, because rates are low. It's highly correlated with the rates. So essentially the Fed is driving everything. And to your point, as the economy recovers and we get back to this normalized economy, and add to the Federal Reserve, you add the fiscal policy that we didn't talk about, which on that front, we've been very, very aggressive. You know, we've seen the PPP loans last year and the cash that everybody got, the checks that everybody got. Well, they got another round of checks this year. So we're putting cash in the people's pockets, and they tend to have a high propensity to consume it. So that's another big risk factor from an inflation risk standpoint. But the Fed is looking at the overall picture, and as I mentioned to you, they believe in this transitory phenomenon, and that's why they haven't really been aggressive in terms of dialing back, the purchases or what they call the tapering. What the consensus is the Fed will continue with these purchases till the end of the year. So till the end of the year, they'll keep buying at this rate. They really want to make sure that the employment will get back to the normal run rate. We're still missing about 8 million or so jobs relative to where we were pre-pandemic. So yes, as the economy is recovering, we still have a lot of slack in the overall system. So they want to make sure that all those jobs will be recovered before they take the pedal off the gas. So the side effect of that is they want to make sure that everything is smooth. They don't want to cause a huge sell-off in risk assets. As they take the pedal off, as they keep buying less, that will be an interesting development from a risk standpoint, how the equity market takes it, how the credit spreads takes it. That is the big question that they face.
This additional liquidity, would you also say that's diluting yields across the board? creating all that liquidity? Is it keeping those yields low?
Yes, it's
Definitely.
basically creating a zombie market.
Definitely.
We don't really know what the fair value is anymore. Spreads wise, treasury wise. There was an interesting anecdote. This is getting a little bit offside, but there was one quote that I remember last week, the Bloomberg was talking about that the JGB 10-year Japanese bond 10-year was unchanged because there was no trade on that morning. Well, that's because the Bank of Japan is buying the most of the paper, and essentially there's just no market. We haven't gotten to that point yet, but the Fed is really influencing the market. They're controlling significant shares, and we're heading towards that trend. And that's the worst thing you can do is, essentially create a zombie market where there's no fair value. You got this price insensitive buyer that is influencing everything, and everything will be misaligned from a supply demand standpoint. So that's something that we fear as an investment community, but it's very difficult to get back to the normal from a Fed standpoint.
Well, the opposite of the zombie market is there no one loses. You have winners and losers. Zombie market keeps things so cheap, so money's so plentiful that even weak companies stay in business.
Yes, and
That's where we are now.
over 20% of the high yield markets are companies that can't meet their interest payments. How do they stay in business? The Fed is allowing them to stay in business because they can just roll the debt. There's a lot of liquidity. Everybody's so thirsty for yield. They give money to any company. Doesn't matter what your cash flow is. I give you my credit, right? So the companies are able to refinance the debt, even though in a normal market, nobody would lend them money because they can't meet the interest payments. So what's happening is instead of having the capitalism get to work, if you will, by, making sure that the weak kind of go away and you get the next competitive company out there, you're basically flooded with these inefficient companies that are actually contributing to the deflationary world by having more supply than it should be on every industry, because a lot of these companies are still being allowed to remain in business, and they're keeping the prices low in the long run.
I think the Fed's balance sheet just reached an all-time high. of
8 trillion.
8 trillion, and
Yes.
they're anticipating 10 trillion by the end of summer. So like you're saying, they're just gonna keep liquidating.
They keep buying.
Yeah,
keep buying.
well, yeah, that's what I mean. They're gonna keep liquidating the market by buying the bonds and
So they buy bonds, their balance sheet is down.
Right.
Do you give them a sense of, Greg, how much the balance sheet has grown? Where was it back in the past when you can remember?
Well, not too far from current, pre-pandemic, they were talking about trimming it because at the time they were talking, low threes, 3 trillion, right? So in just less than a year, they doubled it. And just in the last few months, they moved another up, trillion from 7 to 8. So in the matter of, a year and a quarter, they've increased the balance sheet by, $4 trillion, actually more than 4, almost $5 trillion. So they've more than doubled the balance sheet just in the last year.
This is what governments do when they're in
And that's been the
Yeah.
source of all this speculative mania. You've heard the terms of
meme
SPACs,
stocks. Yeah.
meme stocks. You've heard the cryptocurrencies,
Right.
all kinds of cryptocurrencies. They're going up 2, 3, 4, 5-fold in less than a month. So these are all the side effects of having this irresponsible monetary policy. And we believe that they're not going to rock the boat from an interest rate standpoint, but they might be comfortable with releasing the other pressure valve, which is the currency. They would be more comfortable with a devaluation of the dollar, and that is where everything kind of ties in terms of the overall equation. But that means lower standard of living for everybody. But that's something that it's a long-term issue that will be talked down the road.
Is that the reason why you increased the treasury holding so much with the bonds? Probably because of devaluation?
It's primarily more on the risk side. The
Yes,
credit
sir.
spreads are so rich, you're just now getting paid to take that incremental risk. And we believe that rich means the difference between what the corporate yield is versus the treasury yield. That's how that corporate market trades, on that difference. That's what we call the spread. You do a time series analysis and you take the long-term average of that difference. If you look at the current levels relative to the average, that difference, the current level is way, way much lower than what it used to be. And that is a direct result of what the Fed is doing. They're pushing everything to the limit, to the extreme limits.
So you have credit risk for the corporate, but you're not being compensated for that. Because you can buy a treasury with almost the same yield.
With a minimum give.
no default.
So why would you take on credit risk, right? So that's the thinking behind the portfolio there.
Yes, sir. Thank you.
Any other questions?
No, sir.
All right, well, thank you.
Yes, sir. Motion to accept the Sawgrass report.
Motion made to accept the Sawgrass report by Dowell,
Second.
second by Mr. Leary. All in favor? Aye.
Aye.
Motion passed.
Thank you.
Thank you, sir. Next on the agenda is Capital City. Mr. Madron.
Morning, can you hear me?
Yes, sir.
Yes, sir.
I think you may have this in front of you, and there we go. Jill has it up. Jill, if you could page down to the policy review page. Pages are not numbered, I apologize. So here's the policy asset allocation and actuals as of June the 2nd. Optimism abounds. Equities have done well, as you probably already know. As of June 2nd, we were slightly overweight on cash, as I've had to trim back equity as it grew a little too fast. And I'm still overweight US large cap equities at the expense of being underweight international REITs, infrastructure, and bonds. And that's because of the dominance of technology in the S&P 500 and the success of the larger US companies. So still have that overweight to large cap. The S&P 500 has an awful lot of international companies already in it. So there's not a terrific need to gain international exposure elsewhere. Nevertheless, there is some opportunity out there, and we still will maintain a decent weighting to international. If you could page down a little bit more, you can see where we have the underweight to REITs, a little bit underweight to infrastructure, which eventually will change. And then convertible bonds are underweight, and that's at the expense of being overweight the large cap equities. And then bonds are just slightly underweight. So a moderate growth portfolio slanted towards equities as the economy reopens, because that's where the growth is, and you need growth to get to your actuarial rate of return. If you page down, Jill, to the first performance page. And so this is the good news. This is as of March 31st. Like I said, optimism abounds. The broad US equity market returned 6%. In the first quarter, international returned 4%, mid cap 13.5%, and small cap 12.9%. What was in favor? What worked? Value companies worked. Value meaning cyclical companies that tend to do well in the early stages of an economic recovery. Small cap also did well because small companies benefit when the economy reopens. They tend to grow faster, and they are normally in favor because when the economy reopens, risk is on, and investors flock to faster growing, riskier companies that benefit from a favorable economic and business climate. So what was unusual is that value stocks outperform growth stocks. We haven't seen that in a while. In other words, technology lagged behind companies like banks and energy. And so it was a little bit surprising. We haven't seen that rotation in a while. Nevertheless, the S&P 500 index, where the bulk of your assets are, is split sort of halfway between value and growth. So you were able to capture that rotation into value. And so what I'd also like to point out is the one-year number is unusual, 62.7% on equities, outperforming the S&P 500, 51% on your bonds, which are the convertibles and the high yield bonds, real estate 36%. These numbers although we'll take them and it's nice, you won't see them that often. So let's not try and expect this all the time, but nevertheless, we'll take it. So year to date through March, 5.59%, equity 6.4, bonds 0.28. As interest rates and inflation start to creep up, it caused the high yield bonds and convertible bonds to step back. Real estate's doing just fine as businesses start to reopen and pay their rents again, and interest rates are low. And as you know, real estate prices have gone up because of the demand for housing and apartments and other types of real estate. So, good news to report. I did pull up the fiscal year to date number for you on the equity side. So through April, fiscal year to date was 26.89. That's not including the Sawgrass return. So May and June have been good. So it's possible we might finish the fiscal year up in the 20s. We'll see what happens. If you page down to the next page, you can see.
Dwayne, before you do
Yes.
that, taxable bonds, it says 51.06.
Right.
What does that mean?
That's high yield bonds and convertible bonds together.
Oh, I see.
Right.
But
And part of that was that.
Just so you know, for policy, the convertible bonds are defined as equities.
Right.
So just so you know, we don't characterize those as a bond.
Right. I'm aware of that.
Okay.
My software classifies them as bonds. I'm not sure I can change that because of the way our trust and accounting system classifies them. But I do know they are considered equities for purposes of the policy.
And this slide is for what period ending?
This is through March 31st.
Okay, thanks.
Sure. And then I have April's slide. If you go down one more slide, please. You can see where we are in April because April was a terrific month. The year-to-date number jumped to 9.96. Equities are up 11.2 through April. May was a decent month. June is shaping up to be a decent month. I think the second quarter will be just fine. You can see where bonds are still returning. The bonds that we own, the high yield and the convertibles, are up 2.2. So they're behind equities or the large cap equities that I spoke of earlier. And real estate's doing terrific. Perhaps it would have been better to overweight real estate. So maybe that was, in hindsight, that's what I should have done. So any questions on the return so far? If not, we can page down to the next slide, which is the asset allocation as of June 2nd. So this is where equities are 56%. Of course, this doesn't include the high yield or the convertible bonds. And then, of course, real estate is considered equity. And then I know infrastructure is not on this page. But if you just classified it in a traditional way, you would call this a moderate growth portfolio, certainly not aggressive. But I just put that in there for information. So 56% equity. If you include the infrastructure, probably closer to 60% equity. If you want to page down again, the rest of the report of the holdings. There's the Sawgrass CIT. There's the convertible bonds, the high yield bonds from Vanguard. If you page down a little bit more, you can see some more of the funds that we use. There's the small cap, mid cap, institutional index, which is the S&P 500. That's where the bulk of the assets are, 2,557,000. And you see the international, which are split approximately halfway between index passive and active. And I believe that concludes my comments. Any questions? There's the real estate fund. Any questions? Good numbers.
No, sir. Thank you.
You're welcome.
Dwayne, do you feel it's still not viable to put a little more money in the real estate?
It's run up so much at this point. I really would
believe it
rather
was the
stay
top performing.
overweight in the larger companies because as the economy starts to recover and mature and become expensive, it's the larger companies like the Walmarts and the Targets and the Microsofts that pull you through. So I'd rather depend on them than on rents.
Okay, I was just curious.
Yep.
No, sir. Motion to accept the Capital City Trust report.
Second.
Second. Aye.
Aye.
On to item number 6, Burgess Chamber report.
Thank you. Good morning. Just to, if I could, just to go back to real estate. Were you asking in general about commercial real estate?
Yeah, I mean,
Okay.
everybody knows what's happening
So-
with residential, so I was just curious.
So our read on it is that there's been a complete transformation of opinion in the last 12 months. This time last year, there was a lot of worry, especially in the retail area, office as well, that this COVID business was going to really wreck the real estate market. And that's why we saw that 35% drop among REITs in the first quarter of last year. What's happened is, with all the stimulation that we heard about and everybody spending money and the economy staying erect, and the real estate, commercial real estate market really has remained quite strong. Occupancies have been surprisingly strong in office. And we all know about multifamily has been very strong, apartment renters. Industrial has been extremely strong. And now we have an issue with replacement costs have gotten higher and higher. So an existing office building, even if it's only 90% leased, or 80% leased, is still retaining its value because to replace that building, that extra money or premium has grown even more than where it was a year ago because of rising costs of everything from rebar to cement to copper, wiring, roofing material, everything. And so that, I think, goes back to support the notion that commercial real estate still has legs within this current cycle. Let me take you to page 15 and give you a sense of how well you're doing around the United States. This peer group is a collection of pension plans like yours. The data is collected and then rolled into this ranking system. So the rolling one-year number is, I'll start with that, the 38.3%.
I'm sorry to interrupt you. What page did you say?
15.
Thank you.
Sorry about that. That's 17. That's 13, 14, 15. Thank you, Jill. So those 4 different colors represent the 4 major segments of the market. The top sort of purple segment is the top segment or first quartile or top quartile. And then the red area is the bottom. And you can see that for the one-year period, the program here ranked in the top 26th percentile. It means that you essentially outperformed 74% of the other plans. Little old Palatka, Florida fire outperformed 74% of the other pension plans. And that was done without doing anything fancy or expensive or esoteric. It's just the basics. The equity allocation has remained above the target. The bond allocation has essentially been below the target. And I think Dwayne's done a great job in giving you the right mix throughout the year. If you look at the 3-year number, 11.3, top 18th percentile. There's another great number, 82% of your peers did not do as well as you. And it's primarily because of your equity, domestic equity exposure. Now, there are a lot of bigger plans around the country that have spent an awful lot of money and time trying to be smarter than everybody else, primarily investing in private equity, alternatives, hedge funds. Many of these approaches have been very expensive, illiquid, difficult to value, overly promoted. And I should add that a lot of that money came out of bonds to fund those private programs. And many pension plan trustees have lost, and their consultants, I think, have forgotten the importance of having the traditional bonds. And you can see on page 14, approximately 2.8 million here is in bonds. If we have a protracted, on page 14, a protracted drop in the equity market, let's say the equities are down 15%, and it's going to take a couple of years for those bonds to, for the equities to recover. The only liquidity that you have here to pay the expenses, to pay the pensioners, are the bonds, because the bonds will have actually gone up in value. Bonds and equities move in opposite. So when you have a big sell-off in equities, the bonds go up in value, and your bonds are liquid. And that's why you have them. And when you load up on a lot of private stuff, in lieu of bonds, you don't have the liquidity. And then you're forced to sell the equities at a loss. Equities go down, they come back. But if you're forced to sell them, you've now recognized those losses. So keep that in mind about liquidity and the importance of bonds, even though best case scenario, next year, we're going to make 2%. Okay. Page 16. I'm trying to show some things that Dwayne didn't show you. You can see where the big drawdown that occurred in the first quarter of last year. During that period, the bonds did really well here. So there's an example of how bonds were up over 3% during that period. And in the next quarter, the bonds were up close to another 3%. But what's interesting is how fast this thing recovered. Many so-called experts, and if you want to listen to experts, don't listen to the TV. Unless you want to listen to late night, comedy stuff. But most of the experts said that we were going to have a W recovery, that we'd have a pop and then a dip down. And then it didn't happen. It was a V recovery. On page 17, all these little symbols represent different asset classes. In the northeast side are the risk on or the equity type choices. And then in the southwest quadrant, that little plus sign are the bonds. And you can see that really what we're doing here is we're positioning the allocation along that capital line with that 45-degree line. And if you want to move that blue target up that slope, you can. That's easily done by simply adjusting the target allocation towards having more equities. And if you do that, you will raise the expected return. You'll move away from fixed income. You'll have more equities, and you'll have more associated risk. You're in a good place, I think, where you are right now. On page 1, is Patrick still on?
Yes.
Yeah, you notice how I was sort of dancing around the book, starting on page 15, and I learned that from Patrick.
Did you ask me something?
No, not yet.
Oh.
On page 1, we did as complicated as cryptocurrency is and Bitcoin, we were able to condense it to 1 page for you. So our position, we have some clients that have asked us to look at cryptocurrency, Bitcoin. Our view is that Bitcoin is a fad. Some call it a fraud that won't be around much longer. As soon as Bitcoin gets large enough to be a threat to the sovereignty of countries, then the central banks will quash it. China has a month ago announced that it's illegal to own Bitcoin or to trade it. India has already done that. Those are the 2 most populated countries in the world. Japan has done it. We haven't done anything yet. Central Europe hasn't done anything yet. The UK hasn't done anything yet. But once it gets large enough, it's going to be quashed. And when organizations can use a Bitcoin to extort money from the largest pipeline company in the United States, Colonial, hundreds of hospitals, cities around the country, we're in the hundreds of millions of dollars of extortion that's been paid through this portal. It's wrong and it's illegal, and it's not going to last much longer. At some point, the United States will finally figure out how to shut it down. We're getting close though, because after that Colonial extortion, our operatives were able to actually go into those wallets and actually recover some of that money that was paid. So I think we're getting smarter now on how to track down the bad guys. You still making a lot of money with your Bitcoin?
No,
You out of it?
never was in it.
Okay. I see. Good. On page 4 is the summary. I just wanted to point out that you still have about a 65% target weight to equities. Dwayne has been pretty consistent about running the equity allocation up around 70. When it gets a little above, he trims it back, but he's that additional 5% or so with the emphasis on domestic equities as opposed to a pure foreign. And he's right. The 500 domestic index is roughly half of the earnings of those U.S. stocks come from foreign operations. So as you can see down the page, how well you've done. I showed you your peer rankings are very, very good. And I know that Patrick is asleep again, but I know that Patrick is on occasion will provide you. There he is. He's awake. Good morning. I will provide you with a sort of a roster of how well Palatka fire pension looked compared to their other clients throughout the state. I'm sure you'll get that at some point in the future. And that's all I have. Any questions?
Questions?
No, sir, no questions at this time. Thank you.
And I'll be here for the duration. You may have some later. Thank you.
Thank you. Motion to accept the Burgess report.
Motion's been made by Dowell to accept the Burgess Chambers report.
Second.
Second by Mr. Leary. All in favor?
Aye.
Aye.
Aye. Motion passed. Next up, item 7 on the agenda is Ms. Cassandra Harvey from Klausner and Kaufman Jensen.
Good morning. Can everybody hear me?
Yes, ma'am.
Yes, ma'am.
Wonderful. I just wanted to remind you all that your Form 1 financial filings is due July 1st. And I believe you can do them online now, but we recommend doing them, sending them certified mail if you can, just so there's proof that it was sent. There is a $25 fee. I believe there's a grace period. So I have to double check, but I believe if you don't file it by September 1, then you start to incur a $25 fee up to $1,500. And that is out of your personal money, not out of the pension fund. So the state does say file it by July 1st. So if anybody needs a copy of it, or if there's any questions, please let me know. It's my understanding that I think Sunny with the city helps you all with that. Are there any questions about that?
Did you get one?
No, I haven't received one yet.
Okay. I've already filled mine out and already turned mine in, so mine's good, but he just was on the board, got sworn in March, so I guess we got to see about getting his.
Okay, if you can double check yours, because I checked this morning and it looked like nobody on the state's website had filed in on the pension plans. So
I just
when
turned
did
mine
you-
in the end of last week, so I don't
Okay,
know.
so
if
that's,
it's,
that could
I
be
did it
why.
my local tax or supervisor elections.
Okay, that could be why it may take some, a few days.
Yeah, I
to
just did it
register.
Friday, so.
Okay, good.
Is
Yes,
it-
ma'am.
Is it those board members as of December 31st?
So the state says, let's see, 30 days within if you're a new trustee, it's 30 days within appointment or employment. Or if you've been on the board for some time, it's by July 30th. July 1st. Was that your question?
Sunny was telling me that it's everyone who's on the board as of the end of the calendar year.
Let's see, within 30 days, I can double check, but I'm pretty sure it's within 30 days of appointment. So if you're appointed today, then within 30 days of today, or for those who've been on the board for some time by July 1st. I'll double check and get back to you in between meetings.
Thank you.
You're welcome. If there's no other questions, it's been a good and slow quarter for us over here too. So there's no other, nothing else to report on my side.
Yes, ma'am. Thank you.
Thank
Any other
you.
questions?
No, ma'am. Thank you.
You're very welcome.
Next up will be the budget for fiscal year 2022. Any questions or discussion?
No, sir. I've noticed a few of them changed, but I don't have a copy of the 21 budget in front of me unless that's referencing this stuff on the right column. Yes, ma'am. Thank you.
We probably won't make those investment fees from Sawgrass because they did give us $10,500 back. So this current fiscal year, those are going to be less.
Yes, ma'am.
Okay. And we're still, did you find out, I know this is about the upcoming conference?
They are not putting it on the website yet. I'm
Okay.
assuming they're going to have it because they sent out information.
So I
that it
checked
exists.
again. I didn't know if they
No.
got anything different.
No.
Which conference?
Uh,
State, not FPPT. Texas A&M.
no, it was the 175, 185s. They usually do one in Tallahassee and Orlando. The Tallahassee one was canceled, but the Orlando one's supposed to happen. They sent it out and said it was coming, but didn't put any dates with it. So, any questions on fiscal year 2022 budget?
No, sir.
I'll entertain a motion.
Motion to approve the budget.
Motion to approve the 2022 budget was made by Dowell.
Second.
Second by Mr. Leary. All in favor?
Aye.
Aye. Motion passed for 2022 budget. Next on the agenda is the quarterly expenditures. Any questions on or discussion on the quarterly expenditures?
No, sir. Not at this time. Mr. Leary has any?
No questions.
Motion to accept the expenditures.
Motion to accept the expenditures by Dowell,
Second.
second by Mr. Leary, all in favor. Aye, motion passes. Next up, public comment. Yes, ma'am. Yes, ma'am. No public comments. Any other business discussion?
No, sir. Motion to adjourn the meeting.
Motion made by Dow to adjourn the meeting at 11:16.
Hi, guys. Nice to see you.
Thank you.
Thank you.
Bye, everybody. Stay safe.